Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Well, good morning, good afternoon, and good evening, wherever you join us from today. I am here with my new good friend and friend of a very good friend, Dominic McFadin. Great. Welcome to the Debt Doctor podcast.
Hey, Bill, thank you so much for having me. I've listened to a number of your podcasts and really great show. Honored to be on it.
Thank you so much. You are in a unique class of individual that is really kind of the first of this genre that I'm interviewing as part of this new podcast series. For those that have followed me on the Real Estate Lowdown or in my various webinars over the years, I often connect with and there is a large class of unknown real estate investors. Well, they're known by some circles, but it's unknown how much this industry has grown over the last 15, 20 years to have mom and pop real estate investors finally having access to the secondary mortgage market in terms of buying notes, learning how to create seller finance notes, learning how to buy other people's creation of debt, and how to profit from that. And Dominic, you kind of grew up in this world. Maybe you could start by giving a little bit of a history of how you got into the industry and, what brought you to the place you're at today.
Yeah, so my journey into seller finance it's been a family business, if you would call it that. My grandfather, we've been in the business for about 80 years here in San Antonio. So anywhere from land development to apartment building to seller finance. And after World War II, my grandfather was a big poker player. He was a good poker player, and that allowed him to build, long story short, build his first apartment complex. And in the basement of this apartment complex, he'd have these really high stakes poker games, from what I'm told. Police chief and thing like that. In San Antonio, there was a lot of stuff like that going on.
I'm sure.
Yeah. So he played a lot of poker, and I think he took a lot of people's money, and so they needed to kind of recapitalize, and so he started loaning people the money that he's winning, and that started into a personal loan business, almost like a loan shark type thing, but that afforded him the ability to continue to develop around the San Antonio area. And eventually he partnered with some people, and they had done some land developments, sold the lots off. And then he had run into an apartment and said, "Have you ever thought about offering seller financing on these?" And said, "Well, I currently have a hard money lending business, I guess, if you will. I mean, it's uncollateralized, but this is a better deal. I can wrap the debt up with real estate, and if they don't pay me, I can take it back." So one thing led to another, and through the 90s and 2000s, the business just continued to grow. And so my background was I went to school for business and finance, worked in banking from teller to loan officer to credit analyst to mortgage loan originator, pipeline analyst. I mean, I did a bunch of different things within the debt space. And finally, my sister and I made it all the way back around to the seller finance space. And one thing led to another. We took it and ran, came into the business, and um, it just kind of took off from there. I did not have a book of business in seller finance, but I went out of my way to try to meet as many people like yourself, Bill, that were
Hmm.
in the space to learn from, to pick up every piece of knowledge. I went to every conference I could. But our niche in that business, which was unique to everybody else, because in 2021, 2020, everybody was talking about Burr and doing all these other things, all these trendy, I would call real estate investment techniques. And our business had always been, we buy seller finance debt secondhand at a discount, performing first lien seller finance debt at a discount, and then we hold it until maturity. So we don't have an exit plan as far as we're going to sell this debt after X number of payments. We're only going to set it up in this type of structure. We establish ourselves as a kind of a one-stop shop. So we can buy the debt, we can service it in-house, and at that point, by the end of 2020 or beginning of 2024, mid 2024, we had about 2,000 notes in our portfolios. Over 3 years, I purchased about $38 million in seller finance debt just here in Texas. We bought at about an 18% yield. So that was about a 30% discount across the board. And then we serviced everything in house. So we had our own collectors. If a loan started going bad, we would go through the workout process, whatever we needed to do to keep those monthly payments coming in. Um, kind of I guess, an aside that a lot of people don't understand, I think, in the seller finance or the financing business is that we're not necessarily in the real estate business. We're in the notes receivable business. So we don't want to take the real estate back. In the performing world, we want the monthly payments. We want those monthly payments to keep coming in. That's what we want. We want to make money on that interest. So that's what we did. We would take it through the whole process. And if we had to foreclose, fortunately, we're in Texas. It was a very straightforward process. And local economy is strong. So we'd take the property, we'd put it back up for sale, owner finance again, collect a new down payment, and start the whole process over. Through that process, though, we had a number of loans that didn't fit our buy box. And I would say primarily it's because we're yield driven and we're discount driven when we're buying this debt. We want to make sure there's plenty of equity in these notes. Through 2021, 2022, there was a tremendous amount of seller finance debt being originated, but it was all being originated at a 30-year term. And so to get a discount, to get an 18% yield on a 30-year term, you're talking about a really big discount, and it's hard to get sellers to do that. So that kind of stuff, because we only bought debt that we wanted to buy and we didn't buy the stuff we didn't want to buy, we let a lot of things fall to the wayside. So my sister and I had thought about it for a long time. We thought, there's a lot of opportunity being left here on the table. And what could we do with those 30-year notes that we can't touch, that we're just not able to buy? Is there an opportunity out there for somebody else to buy it that maybe isn't looking for an 18% yield, that might be more interested in like a 12 or even a 10? And to a lot of people, I mean, that's, when CE rates are low, that's a good return.
Yep.
If you're about real
Especially
estate,
if you buy it into a self-directed IRA or some other
exactly.
tax-free system, even a 9% non-tax return is a very, very strong return, especially over a 20, 30-year period, knowing that it's backed by real estate.
Exactly. So we started looking at that, and one thing led to another. My sister and I, we established a company called Note Buyers of America, and we buy, sell, and broker mortgage debt now, essentially across the United States, but primarily we're focused on Texas at the moment. And it's been a great business. We're working on growing our own portfolio, and as I mentioned to you earlier, now we're finding our way into the servicing space, buying a servicing company. So we're kind of making a full circle here
Right,
on where we're
right,
headed.
right. This is great. There's so much to unpack here, and we're going to take some steps back in a moment. But I don't want to step over the fact that your grandfather, was it that, or is it great grandfather who was the poker player, the Doyle Brunson of his
Grandfather,
grandfather?
grandfather.
So
Yeah,
he goes from being the Doyle Brunson of San Antonio to obviously well connected, having senior leaders in San Antonio either indebted to him or at least sitting at his poker table. Sounds like your dad was quite a connected guy, or your grandfather. Seeing your name McFadin, you're not Italian, obviously, by
Yeah.
heritage. So then putting money on the streets of San Antonio 100 years ago or 80 years ago, whenever it was still a Texan style of debt. And it is interesting and it's so smart of what, there is a difference between you know, just a handshake. You owe me money. Yes, it's at a high interest rate, but I'm going to come and collect. Versus the asset-backed loan, which is really the kind of the epiphany I think that your grandfather had, saying, "Wait a second, people are willing to put up their property uh, against this loan. I'm so much more secure than I was just doing street loans." Um, and I think that that's what's attracted a lot of people across America. I know when I got into the debt buying business, in the real estate debt buying business, was a great financial crisis 17 years ago. So I've watched a whole cottage industry for people who are friends of mine that have gone on, some of whom gone on to become institutional managers of their own small funds, mid-sized funds, and a lot who are just mom and pop investors. And I don't mean that in a pejorative way. They have a living, they own some real estate, they have a 401k self-directed that they can buy real estate or real estate related debt through. And this is a very interesting way to get at it. But I think what's even most interesting in the world that you can maybe shine a light on for the everyday person is just the idea that there's seller finance notes everywhere, that there are all these notes exist to buy, that there's this industry because, I grew up in a judicial foreclosure state. Yes, there were
I'm
some
sorry.
financial yes, there were some seller finance notes in our world. We learned about it in real estate brokerage school 25 years ago, whatever. But this is really, I mean, it's kind of born out of Texas. Can you kind of give that history? I think you had told me once before that, like, the numbers of how much seller finance debt there is, how many and why Texas of all places. Well, I know why, but I want you to tell everyone else.
Yeah. Well, I mean, I'm going to butcher some of these numbers, but in general, just as a staple, Texas does 25% of all the seller finance production in the country. And so that's almost more than the other top 10%, other top 10 states. So like Texas does 25%, and I want to say Florida only does 8%. And
Right.
so there's something going on in Texas, and there's a variety of different variables that people can argue, but one of them is you've got a lot of what I would consider very high qualified borrowers that come over the border legally but can't get a traditional mortgage at a bank. They're hardworking. They might get paid in cash. They might get paid unconventionally. They just don't fit the standard boxes that Chase and Wells Fargo are looking at. And so seller finance fits that mold perfectly. I think just in general, that's a stigma that seller finance has always had is, oh, well, it's subprime. It's not as good of debt that you can buy from an institutional. And I don't think that that's true at all. I don't think that's true at all. I mean, I've personally met borrowers that, were given an opportunity to own something and they took the ball and ran. I mean, you go sell them a piece of land, you'd go back out there 2 months later and they've got a beautiful single family house that they built themselves on that property. I mean,
Wow.
it happens all the time. So you're talking about, you're buying something that is drastically appreciating. You're not, it's a great business to be in. Um, in regard to just the statistics, though, I mean, that is, I think, the primary
Mm.
driver. We're a bordering state with another country. We are a non-judicial foreclosure state, so the foreclosure process is very simple. The laws around protecting lenders, I would say, it's very lender favored, um, and it's just a good economy to live in. It's a good place to live in. The quality of living's
Hmm.
high. So there's a number of different variables I think that
And so
contribute to
what
the.
causes then and obviously this makes a lot of sense. There's this world of uh debtors, especially in a market that's as culturally diverse with as Texas is. There's a whole market of non-bank worthy borrowers or folks that just
Hmm.
don't want to go through the headache of it,
Yeah.
and then you combine that with the reality that anyone who lends money against real estate, if they don't pay, it's like evicting them from a rental. It's the same thing. So it seems like a business that makes a lot of sense, especially in Texas. So then what happens? Why do sellers come want to sell? Then how do you end up owning these, and where are you sourcing this product from?
So that's the really interesting thing is, and this I don't know exactly why this is the statistic, but it's roughly 90% of seller finance debt is originated by somebody that has originated one loan annually. So if you think about if you're doing one loan annually and you're relying on the cash flow from that one loan, you probably aren't going to continue to do it. Uh, it looks good on paper, right? But it does take some work to set the loan up the right way, find the right buyer, service the debt. But that is the statistic. So 90% of these people are generally they're one-time shooters, and that's it. So when we're looking at debt that we're buying, that's primarily who we're targeting. We're looking at deeds of trust that have been recorded within the last 30 days, 60 days, 90 days. And then we're reaching out to those people. We're sending them letters. We're calling them on the phone. And sometimes they don't want to sell immediately. Sometimes they say, no, I've originated this. I'm going to hold it for the long term. And then I mean, I couldn't tell you how many times, Bill, I've sent a letter to somebody, and 6 months later or a year later, I get a call back from that person that says, "You're the first person to reach out to me. Tell me how this seller finance thing works, or tell me how selling this debt
Selling my
works."
note works. Yeah,
Yeah. So
that's re-
that's
yeah.
that's the traditional. It's 90% of people are only originating one note, and so I don't
Wow.
think that they're really in it for the long haul. They think that they are, but eventually you get tired of collecting $900 payments, and you want that $50,000 payment,
Right.
and that's where we come in. Yeah.
Very interesting. And it's so interesting that it's like, that there's this industry that it seems like, especially in Texas, where you farm and where you're from, it's almost like more of a known thing there, obviously, because if you
Hmm.
have people doing one-off seller financing, then that's a word of mouth. That's hey, that's like it's part of the way, I guess, in which you can sell real estate, I suppose. I wonder and then when they do come to sell, well, first of all, let me take a step back because I want to think through all the questions that people might have about the seller financing process. The Do most of these loans end up following a set format? Is there even a state format like there is for real estate contracts or anything like that in Texas?
Yeah, so Texas is traditionally a promissory note, deed of trust, warranty deed state. And I've always been told by a number of different, CFDs still exist out there in certain states, and you even sometimes see CFDs in Texas. But I've been told by a few different people that I respect that if you see a CFD, you can't buy it cheap enough. There's a reason
FYI,
that,
a CFD is a
yeah,
contract for deed. It's a different document than a mortgage. There's a
yeah.
whole world of that. He's saying Dominic is suggesting we stay away from that, right? Is what you're saying. CFDs.
Exactly. Yeah.
Okay.
Because
Okay.
the deed of trust, warranty deed, note package is such a strong package, especially in worst case scenario, you got to take it back. And I would say that kind of as an overarching theme, what I was always taught by my family and the people close to me is when we're buying debt, I always have to look at worst case scenario because tomorrow's payment is never guaranteed. It doesn't mean that the borrower's not going to pay. It means that something could literally happen to that borrower where we never get a single payment. And that has happened. So we have to look at that note, that piece of real estate as, okay, what do I do if I have to take this back immediately? How am I going to sell it? What kind of down payment am I going to take? How quickly is it going to take me to turn this around? So in Texas, that note, deed of trust, warranty deed plays into that formula because it determines how quickly you can turn that loan around and get it back performing again.
Understood. Okay, so the average, most of them follow a certain format, which is like you said, the the mortgage no contract, deed of trust, warranty deed. All of that gets packaged. There's stuff. Certain documents get recorded. The borrower defaults. But the document wording itself could obvious. I mean, deeds are pretty standard. But I would assume that folks doing seller finance mortgages, I'm sure they get the help of a realtor. They find a form online. I mean, it's probably pretty simple, but do you ever come across some seller finance notes that you want to buy? Okay, the seller does say, okay, I'll sell it to you. And then you read the document and you realize that, wow, these people wrote something that's unenforceable or
Yeah.
anything like that.
So that is the double-edged sword. Having the 90% of people originating notes that don't necessarily know what they're doing or have limited education, they may get documents from an attorney or a friend of a friend who used it, or they may just make up their own. I mean, it's becoming more common with ChatGPT and Gemini and all those. You can just come in and say, "Hey, I want to sell or finance this property. Help me set up the note." And it's getting better, but one of the things that's different about our business, No Buyers America, that I learned from just buying debt is we don't make an offer on anything until we have documents in front of us. We can't even I won't even make a preliminary offer. And that upsets a lot of people. We do lose deals doing that, but 9 times out of 10, the information that's given to me up front and the information that's actually on the note can be totally different.
Right.
And so that ties right back into that 90% figure, because there's a ton of variation in how people are originating this paper. There's good paper, there's bad paper, there's compliant paper, there's non-compliant paper. There's just flat out unenforceable paper that, hey, you've got something on your hands that you can't do anything with this. You should try to get a modification done immediately and pray that the borrower, is willing to sign it. So one of the things that is
And how
starting
often
to
does
help.
that happen, by the way? Is that like a small percentage, 2, 3% of the time, or is that 10 or 15% of the time?
Well, I mean, it is pretty high. You'd be surprised how much bad paper we see.
Wow.
Yeah.
So there could be a whole nother if you melded South Florida with Texas, you could have a whole nother cottage industry of borrowers who have taken the seller finance notes and figure out that they're unenforceable and then squat in the property for 10 years.
Yeah. Well, there are car crash attorneys out there for for foreclosures.
Oh, I can imagine, right?
Yeah. And it is common here in Texas too. So, one of the things I think I touched on it, but the stigma about seller finance is that it can be not grade A debt, and uh, it doesn't come with the right disclosures and things to make it a fully compliant loan like a traditional mortgage would. And that has changed a lot over the years. There are now RMLOs that their whole business is just providing RMLO services to seller finance originators.
Oh,
So like guys
interesting.
like Anthony Ferrando, but all they do is non-traditional loans.
Wow, interesting.
Yeah,
I,
yeah, and
I can't imagine you make a ton of money doing that. That's got to be a volume business, right? What do you charge a flat fee or something for some? I guess it.
generally it's a flat fee anywhere from 500 to $1,500 a pop.
Hmm. I would think attorneys, like the kind of like parking ticket attorneys would be good for that.
Yeah, yeah, right.
Right? Okay, yeah. So tell us that. Yeah, go on.
Yeah, so one of the things that kind of spurred that, well, I think it's been on the radar for a long time, and it's something that a lot of guys have been talking about for a long time, especially when it comes to single family primary residences. It's vitally important on the seller finance side. But there's a development out in Houston that is 42,000 lots, and it was developed by two brothers, and they just grew this thing. I mean, it was like a mecca for guys that are working in Houston, but are qualified to be seller finance borrowers, and they want to live in a mobile home and they want to own a half acre, an acre of land. And this part of Houston, low lying, a lot of wetland, things like that. But they were able to come in and develop this. So 42,000 lots they got out of this. But some of the statistics on this are just crazy. So the Daily Wire had done a story on this development because they had found that 92% of the county foreclosures came from this development.
Wow.
Yeah. And 30% of them, let me see. Yeah, 30% of them were, of all the 42,000 lots that were sold, 30% of them were being churned within 3 years. So it's just this hot pocket of seller finance, which a lot of, again, very good borrowers, most of them could be very good borrowers, pride of ownership, all that kind of thing. But it kind of put this black eye on seller finance, and it placed a lot of emphasis on the importance of originating compliant paper.
Mm.
So when this in Colony Ridge made it to the headlines in the Daily Wire, you can read about it. But Governor Abbott was flying over the development. There were other state employed individuals flying over. People were making a very big deal about it, and the story has not completely. It's not been told entirely, but from what I understand, despite the foreclosures and all of those types of things, they did develop the subdivision properly, and they actually originated the debt properly with the right compliant paper. So, but had they not, it would have just been a bloodbath for this
No, for sure.
developer. It would have been really bad. And this kind of shed the light on what I called earlier, the ambulance chasers for seller finance, because now they're saying, okay, we can't go after these people, but this is a really good example of what to look for when you see a deed of trust in foreclosure. Are the right documents present? What exactly is going on with that? So um, it's become more and more important, and especially on the brokerage side, when we're looking at debt, that's one of the first questions that we're asking is, how did you originate this loan? How did you
Yeah.
qualify the borrower? Did they just have a heartbeat and a driver's license, or did you do income verification? Did you look at bank statements? Those kinds of things. But it's becoming very important, and because Texas does so much of this, um, you're actually seeing a lot of good paper coming out. But again, 90% of these originators are individuals. They don't know how to even navigate the compliant, seller finance compliant origination roadmap. So that's kind of part of the process that we're trying to find ourselves in, is how can we provide that service in a way that makes it easily accessible for the individual originator, not just the developer.
Well, and I would think, you even providing that MLO service for 500 or 1,000 as in addition to whatever else you do to teach people on the investment side. I'm sure that could be in your wheelhouse of things that could very easily, you could have AI automate
Yeah.
in a way. There's so many avenues I go down when in what you said, lender compliance being one. Very interesting story, the Colony Ridge story, and the ability of that lender to go out there and overcome the herd media frenzy, the herd judgment, the herd compliance
Yeah.
that comes from being a lender that's in the spotlight, right? And it's interesting though that this is a world that outside of Texas, or Texas, like you said, being 25% of the creators of this seller debt, it's just not as much a common conversation. I think the rest of America, the rest of the world, is probably surprised to hear that this is like such an industry. But it makes sense, and I think that it certainly makes sense for Texas. The way they've done it, is beneficial. What is so obviously, let's just let's I have so many broader questions to ask, but I want to go drill one deeper question in on the seller finance again, because you touched on something about, hey, does this person have a heartbeat, or did you actually verify their income and their ability to pay? To what standard, just on a high level, what are there a couple boxes that every person has to check, even in a seller finance situation? And in terms of ability to repay, what are the basic compliance steps?
Yeah, Bill, the microphone's cutting out a little bit, but I will say in regard to just checking boxes when it comes to seller finance, um, generally you've got to have some type of social security number to be able to qualify for traditional RMLO originated. That they've got to be able to verify your ability to be here. And then income documentation, it varies between the type of loan being originated. Is it a single family primary residence, or is it just a piece of land? You can do a stated income origination, but at a bare minimum, you've got to at least have valid identification. Um, and then I'm not an RMLO, so there are a number of other things. But when it comes to uh, actual qualifications like DTI and things like that, as the lender, you are the bank. So you kind of do get to choose what type of risk level you're willing to accept. The important thing is when you get into those higher DTI numbers, you better make sure that your borrower can actually afford the loan you're about to give them. There's got to be some type of paper trail that shows you made an effort to verify and you were able to determine beyond a reasonable doubt that this, based on what this person's telling you and what they've provided, that they can afford the loan. Certainly not as stringent as a traditional origination, but those are kind of the key boxes that do need to be checked. You've got to have valid ID, you've got to have some type of income verification, and you've got to be able to show this is a court of law that you actually did verify that this borrower could pay for this loan in the event that you do have to foreclose.
On the contrary to that, have you ever seen a borrower go in and have like a foreclosure denied because they said, Judge, they never asked me what my income was? What are the consequences to the lender? And have you seen that happen in recent times in Texas?
So in that instance, we fortunately have been careful enough when we're buying stuff to really analyze the collateral documentation to ensure we don't find ourselves in that position. And I would argue that, anybody you talk to about seller finance when you're buying debt, yes, the returns are sexy and you've got generally a lot of equity in the property, but being able to understand what's in those loan documents and exactly how you would proceed in the event that you had to foreclose is absolutely crucial. We spend a tremendous amount of time looking at doing due diligence on the deals that even we're brokering. So for our company, we're doing due diligence as if we're the investor. So we're looking at 75 plus data points on the note. We're looking at 60 plus data points just on the property itself. We're looking at everything from deed history to our taxes paid, who paid the taxes, is the mobile home real property, what's the ability to enforce late fees and attorney's fees in the note itself and the deed of trust. So that is how you protect yourself from finding yourself in that kind of situation. So we have not found ourselves in that type of situation. I would probably say that to somebody that has found themselves, like if they've bought a piece of paper that they did not analyze properly and now they found themselves in a situation where they're going to have to foreclose, I would strongly advise that person to do whatever they can to do some type of caps for keys situation where they can deed that property back to the lender without having to go through the court system. At that point, you'd want to make that borrower your best friend because you would not want to find yourself in a situation where you lost that entire investment. And it can happen. It has not happened to us, thankfully, but it has happened before.
Do you see an uptick in distress, whether it's borrowers that are late paying or having trouble paying within your portfolio? Or are you seeing an uptick in the number of just the volume of sellers out there of debt? Anything that could point to where the market might be heading in the next year or two?
So I will say that we have seen a lot of people. I mean, every day we've got two callers right now, and we're getting, 3 or 4 qualified deals a day, people interested in selling, because we are contacting these individuals that are they're newly originated notes. A lot of them don't even know they can sell the debt. But they are finding that, hey, the market's changing. I would like to have some money in my pocket. And so that's leading to bigger discounts. We're seeing a lot of stuff trading at 30 or more percent, on the discount side. Um, as far as the quality of the debt goes, there's bad debt all over the place. There's good debt all over the place. That's kind of the beauty of our business, is we get to pick and choose what we want to look at. As far as a trend goes, though, I will tell you, as an aside, just a personal story. One of the businesses that my sister and I have remained involved in is the signature loan business. We have a small loan company, and this loan company makes cash loans to individuals. So you can come in with an ID, proof of income, and you can walk out with up to 1,400 bucks. And one thing that we have noticed over the last 24 months, and really predominantly the last 12 months, is that traditionally these loans are borrowers that have a very high DTI. They're 90+% DTI, and their credit quality is very poor. That's the kind of demographic that fits that type of loan. What we've seen over the last 24 months, though, is we've seen the credit quality increase drastically. So the same customers that weren't our customers before are now needing that $1,200 cash. And in the last 12 months, we've seen that increase as well. So we're seeing, credit scores mid 650s, but they have very high DTI, but they've got good income. They're making $100,000 a year, which was unheard of a few years ago. Most of our borrowers would be, low sixes, below six, and they'd be making $40,000 or $50,000 a year. So we on the hard money, or not the hard money, but the signature loan business, that is a trend that we're seeing. We're seeing a change in credit quality for sure, or change in borrower demographic for sure.
Yeah.
As far as like the seller finance side goes, I mean, DTI is high. DTI is higher for sure.
Absolutely. I want to get into a quick question about interest rates. I'd love to hear your perspective on it. There's a prevailing view in the market that rates are high. I laugh when I say that. And that the Fed will no doubt cut, and they need to cut, and that everyone's kind of holding on for those interest rates to lower, and that's going to happen. Where does that fall short from your perspective?
Well, I guess it depends on the side of the business that you're in. When we're buying debt, we're looking at a couple different variables. Obviously, we're looking at what happens worst case scenario if we have to take that loan back. But also when we're buying debt, especially really nice debt, we want to be able to collateralize those loans and then recapitalize. And in order to do that, we need to make sure that we maintain a certain spread between the yield that we're making on the money and what it's going to cost us to borrow on that same debt. So generally, our rule of thumb is always to maintain a 10-point spread. So if money is costing us 10%, then we're going to buy at a minimum of 20% yield, obviously barring, equity position and things like that. But, that is generally our rule of thumb. And so that's kind of what you're seeing across the industry. As money gets more expensive, we're seeing the discounts become larger. That is something that we're looking at.
Mm-hmm.
I will also say that it's, if you've got cash right now and you're looking at buying debt, it's a great time to buy, because
Mm-hmm.
you can make that argument very clearly that the days of selling a 30-year note with equity at 90% are gone. Those are gone because of how expensive money is. You can buy that same thing at 70 cents on the dollar or 65 cents on the dollar. But as interest rates change, it is going to change how people buy this debt. It's going to change what players stay in the industry, I believe, because I think that through 2021 or 2020, 2021, 2022, 2023, you saw an explosion of people getting into the seller finance investment space and kind of using that model. So they would collateralize, but those loans are generally, the term of those loans is generally much shorter than the amortization of the debt that you're buying. So you've got to either sell that debt or find another way to pay off the underlying lender when that or pay off that bank when those rates do balloon up.
Mm. And if you had to write a playbook for the next 12 months in this industry, what would it be titled? What would be the subtitle and the couple of the chapter names?
Man, that's a hard one, Bill. I would probably say you know, due diligence, due diligence, due diligence.
Mm.
Really understanding the true value of the property, not the 2021 or 2022 value. Where's the true value in the property, and what is your exit plan?
Amen to that. Well, and also on top of that, as things have become bubbly and in the turn since 2021, I've seen a lot more what I would call fraud. Even though it was probably just a borrower taking advantage of a dumb lender and using comps that were out in the market that were probably stale. In my opinion, it was and then first payment default. You got to keep, diligence plays right into that same conversation. Beyond what we've discussed, is there anything that we didn't, any topics that you think are prevalent? And we are definitely going to come back every couple of months and get an update from you. You've obviously, your feet are on the ground, especially in a very niche market. And maybe I need to come to Texas and take you to dinner with Eddie Speed.
I would love that. I mean, I would honestly, I'd be honored to do it. That would be incredible.
Hey,
Yeah.
if you were to leave our listeners with a guiding principle, a prediction, any kind of like one, overriding thought that you think, that either could apply to your industry or just anything in general, you could even go off topic if you want. What would it be?
Well, I think just from the seller finance perspective, one thing that I've always stood by, one principle I've always stood by when I'm buying debt, and I think that a lot of people would benefit from this, and this is something that a close friend of mine told me a while ago, but he said, when you make your offer to buy that note, you should be embarrassed when you make it. Otherwise, you're paying too much for it. And I know that sounds crude, but it really is how you make money in this industry. That's how it's all about how you buy the debt. Yes, the returns can look great on paper, but the guys that are really doing this stuff, like the Eddie Speeds, their returns are looking totally different than the stuff that you're seeing on stage. I can promise you that. And it's because they're buying paper like that. So don't be afraid to make an offer.
That is
You'd be
really
surprised how many people
brilliant.
are
I
saying
love
yes.
that. And you say that, Dominic, in such a way. It's so like humbling yet true. It takes the edge off of the real business mentality. You have to be the kind of sharkishness that it takes when you're buying anything, especially when you're buying debt and wanting to get it at a discount. It's really, really well said, my friend. I love that. Until next time, Dominic, thanks for joining the Debt Doctor. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.